All right. We're good to go. We'll get started. It's 6:03 p.m. This is the Dewey Investment Committee meeting set for January the 27th. Let's see. First item on our agenda is roll call. We'll just allow everybody to introduce themselves. Brian Prevor, Chairman of the committee. Bernie.
Yeah, Bernie Krause. Been on the committee for about 3 years now.
All right, and let's see, Dennis.
Dennis Trencher, committee for about 2 years, driving up from Sarasota, Florida into the storm.
Oh boy.
I know.
Keep your eyes on the road. Michael.
Mike Schaefer, been on the committee about 3 years.
Great. And we have a few other guests with us. Mayor Stevens.
Hi, everyone.
We have our new commissioner liaison, Commissioner Gibbings.
Hi, Elizabeth Gibbings here.
We have Commissioner Persinger. And we have the town manager, Mr. Zolper.
Evening, folks.
Sheena, also from the town.
Evening.
And Dominic from Brown Advisory. So we have a quorum. We have sufficient members present. I know Jimmy may join us later if he's in another meeting, but we can proceed without him as we still have a quorum. Has everybody had a chance to review the minutes from our last meeting? And does anyone have any comments or questions or edits for the minutes? All right, I guess we can move to adopt the minutes. Do we have a motion?
Motion to adopt the minutes.
Is there a second? We have a second.
Second.
Great. All in favor, say aye.
Aye.
Aye. Do we have any opposed? None opposed, so that passes unanimously. And I'm sorry, I should have taken a vote to adopt the agenda as well. Do we have a motion to adopt the agenda?
Motion.
I'll
Do we have a
second it.
second? All in favor? Aye. Any opposed? Noting none opposed, it passes unanimously. So we have an agenda and we have reviewed the prior minutes and approved those. We will need somebody to act as secretary to record our minutes. Bernie, do you mind playing that role again? Thank you very much. Much appreciated. So we would appreciate hearing from the town manager, the next item on the agenda. If you can give us, Bill, just a quick overview of what you anticipate the financial needs are and planning for 2022. Have there been any substantial changes since the end of last year, the last quarter?
Yeah, thanks, Brian, and thanks, everybody. So real quick, a great deal of work has been done by Sheena and the mayor on this year's budget. It's a draft budget right now. It's only a draft, but it is balanced in the draft form that we currently have. Again, the commissioners have not gone through and picked it apart yet and really gotten down into the weeds on it, but it's a draft and it's at about $4.5 million. Based on our general fund policy, based on that, we're going to need about 6 months of the rainy day out of that. So that's about 2.25 million. We currently have about 1.8. So when we talk about needs of investments and monies, that's what we're talking about. We're going to need to bring that rainy day fund up to about 2.25. Major infrastructure projects that are going on. Infrastructure committee just sent to the commissioners, and commissioners voted and approved for about $480,000 for infrastructure projects. Now, let me explain that. That doesn't mean we're actually going to be spending that much, but it means we can spend up that much. I will go in front of the commissioners on each part of the project, the Bayard Avenue project, part of it on Route 1, the McKinley project. And each time I do, I'll go in front of the commissioners, explain what's going on and how the money's going to be spent. I may have Cohen and Resnick come in and go over that also to help explain it. I think the stormwater projects that we're going to be doing as part of the infrastructure is very important. You saw the flooding that we had in October, and we're going to have a big snowstorm tomorrow night. It's important that we get the water off the streets and out into the bay as quickly as possible. And the stormwater projects that we are looking at over the next year or so are vital to get that done. Besides that, I think we just need to look at the returns we're getting on our investments, and then how quick we can liquefy that into cash if we have to. And with that, I'm pending any questions.
One question from me. Thank you for that. That's very helpful. The 480,000 for infrastructure, that's budgeted. Is there money already allocated or earmarked for that 480,000?
So Sheena did a nice workup on that. We have about 600,000 in that account right now. So the 480 is coming out of that account.
Okay, so the balance would just stay as reserves for future infrastructure projects?
That's correct. And then a certain part of the hotel tax, and correct me if I'm wrong, Sheena, will go back into that account to replenish it. No?
Hotel tax will be for capital expenditures. The parking revenue transfer from a part of transfer tax and part of building permits all go to the streets and infrastructure.
Thanks, Sheena, for keeping me straight. There you go, Brian.
Okay, that's helpful. Does anyone else on the committee have questions for Bill? All right, hearing none. Okay, I guess we can move on to our next item on the agenda. We'll keep it moving. Dominic, if you could give us a review of the portfolio. And we'll split this into two parts. First is looking back, how the performance of the portfolio has gone. And then the second half will be much of our discussion this evening is recommendations for going forward.
Sure, gladly, thank you. I think one of the things to Bill, just from a liquidation standpoint, I mean, everything in the portfolio can be liquidated and in cash within 2 days. So just from everything's liquid, so you don't need to worry about liquidity. All right, let me share my screen and we'll get going. Okay, well, this shouldn't be a couple new faces on the screen I haven't seen before, but I guess happy Thursday, everyone. We'll go through performance of those who I have not actually met. It's nice to meet you in a virtual setting. Hopefully there won't be too many more virtuals, and we'll actually get to see each other in person at some point here in the near future. That would be nice. But overall, I mean, portfolio has performed well. I mean, I think overall, we haven't had we haven't taken on a ton of risk within the portfolio, and we've kept it, relatively, tilted. I mean, it has to, just by town policy, to be mostly in fixed income. But if we look at, and I'll make this a little bigger so it's a little easier for everyone to see. So overall, on a trailing 12-month basis, the portfolio is up 5.6%. Overall, since inception, portfolio is up 4.9% on an annualized basis, so 4.9% per year since inception, 2015. Overall asset allocation, I know there were some questions last time. Just we got back to kind of policy within fixed income. We are slightly underweight. We are in a rising interest rate environment, which will bring down the kind of the value of fixed income. And so we like to be underweight kind of strategically, and overweight kind of risk assets. And when I say risk assets, just mean really equities, because it's the only other asset class that we're invested in the portfolio. And so as you can see, kind of here's our kind of overall target. So underweight kind of cash and fixed income, overweight US large cap, kind of at weight kind of small cap, international and emerging markets. Overall, let's go towards the bottom of the screen here on the left-hand side. So when we kind of first started managing the portfolio, current as of 12/31, portfolio was at almost 5.4 million. And again, this is a long portfolio. So this is the long dated portfolio. I know there are multiple buckets and we'll get to the other two in a second. But since inception, we've had almost $1 million in market gain and another kind of 560,000 in income gain within the portfolio. And so that's kind of equates back to that 4.9% on an annualized basis return. Based on the bottom right here, this is essentially the green as if you kind of took your money and put it under the mattress and did nothing with it. And the blue is kind of the market and income appreciation since we've been investing. So you can see, obviously, we want to see more blue than green over time, which is a good thing. It means we're making money, which we all like. So kind of going into the individual investments as we always do, kind of taking a look at kind of how do we get to those returns. So flexible equity overall since inception has annualized at 16.4% relative to the S&P 500, which is annualized at 15.6%. Last year, we trailed a little bit on flex equity, and there was just a lot happening last year. And then, not surprised. I mean, they are a concentrated portfolio of 35 to 40 stocks, and really kind of, I would say, down the fairway on most sectors, underweight to energy. Don't have any real estate, both of which were kind of outperformers in the market last year, and so no surprise that they underperformed. But still over time, they've continued to outperform. We've added the Broadvisor Small Cap Core Fund. I think since the last time that we met. I mean, it's early days. It's only a couple months into it. Small caps had a sell off in the second half of last year, and so underperformed a little bit. But again, it's a very short time frame, and I have all the confidence that the team will make that back. The Global Leaders Fund, again, global strategy focused on 30 to 35 global stocks from around the world. I've done well since we started investing with them back in April 2020. I've kind of kept up with the market overall, up 31.5%. And then this emerging market, Broadvisor Emerging Market Select Fund, as a reminder, this is actually two different managers that are in this vehicle. This is not managed by Broadvisor. We only kind of package it together so that we can actually get access to Wellington Asia, which is they don't have a mutual fund for us to invest in, and so we created the mutual fund. And so it's half Wellington Emerging Asia, and it's half Pazena, which is an emerging market value manager, and so kind of a growth and value manager that we put together to really give kind of broad kind of emerging market exposure. And so it's done well, outperformed the market by almost like 2.5% since we started investing back in 2019. So the other thing we did since the last time we met is we did, I know there were some changes to the investment policy, and so the short-term portfolios where we had originally invested in T-bills, we now are invested in the same bond funds that we're invested in the long. So it's the Broadvisor intermediate income. So intermediate income just means from a duration perspective, it is kind of shorter duration than kind of the Barclays aggregate index, which is kind of a baseline for the bond market or the corporate bond market. All investment grade credit, so all kind of fundamentals driven, all bottoms up. Our research team goes through, and that's every single bond that goes in from a bottoms up perspective. And so kind of good credit. Like I said, the bond market has sold off just because of how rates are rising, and given that inverse correlation between yield and price. So as yields go up, prices of those bonds come down. And we're certainly coming out of a 40-year bull market for bonds, and so it's going to be we'll have to kind of keep a close eye on the bond portfolios. Not that it's like equities and they're going to go down 30%, but there will be a period of time where there will be in slight decline until rates start to normalize a bit more, and then the yield of those portfolios will kind of bring them back from a total return perspective. So feel totally confident in that team and the bonds within that portfolio. So again, just short term in nature and timing more than anything. I mean, I would say that's pretty much it from I'll stop there before I kind of go into any more detail. But any questions kind of on performance or kind of the portfolio as it is today?
Thank you, Dominic. That's very helpful as usual. I'll start off with some questions and observations. If you take us back to the first page, yep, there. Once again, this is the long. This is just long that we're looking at
It's
on
just
this
a
page.
long. That's
Yeah,
correct.
okay. So the long, I make the observation I've been making the last several quarters, which is I commend the performance because you have beat your benchmark pretty consistently, which is not easy to do. And I just see the net on the bottom line there, 5.6 versus a blended benchmark of 3.4. I mean, you're beating it by 220 basis points. So from my standpoint, what I would observe to the rest of the committee is that when we're thinking about who is our investment advisor and why do we pay our investment advisor fees, if you can beat the benchmark, you're knocking it out of the park. Typically, at best, you meet your benchmark minus the fees, and Brown has, I think, served us quite well in that department. So kudos to you. Now, with respect to the details of the portfolio, a couple questions. So you've got in the, I guess it'd be the next page where you showed the breakdown. Yeah, there we go. So the Flex portfolio still performs quite well, and it looks like inception to date done very well. Very good in the 3 and the 5 years. The 12 months, 300 basis points trailing the S&P. Not shocking for the reasons you said, and you pick some winners, you pick some losers occasionally. It sounds like the portfolio does not have two elements, which were energy and real estate. And I know your proposal is to take on some real estate, but how about the energy sector? And is that something that we're really missing? Should we be?
I don't think so. I mean, I don't think anyone can pull up to a gas pump and know that energy prices are higher. I mean, I think it's certainly a core commodity in which we all use on a day in and day out basis. That said, I have invested in energy over the years and kind of personally, and it is a really hard market to pick winners and losers, or to pick winners, I should say. It just is, and it's very dependent upon policy coming out of the White House. It has a lot to do with kind of domestic production and the cost, their cost pressures coming in from overseas, the geopolitical risks. I mean, there's just so many things that drive changes in energy costs, and it's really tough. I mean, you could think it's going to be, people are talking about a bull market in energy over the next couple of years. Yeah, it could be, and it could turn on a dime and no one can see it coming. It's just a really hard market, and they're not opposed to owning some energy stocks where they see value in the Flex equity portfolio, but they were just under. I think they own one energy name in the portfolio, and they've owned more in the past. And if they see, they're not opposed to buying energy names or real estate names, but certainly have an underweight to both of those sectors, and that was one of the things that certainly held them back this year.
Okay. In sticking on this page, I see the emerging markets did very well versus its benchmark. The international, a little less well. I mean, it's still very good.
Yeah.
I mean, 160 basis points.
Yeah.
Is there anything, I guess, first question is there a difference between the emerging markets and the international fund in terms of like parts of the world? Like what is the focus
Completely
that caused one better than the other?
Yeah, sure. No, completely different. I mean, you're talking in the emerging markets. I mean, just what it says. I mean, EM, I mean, so it's 100% emerging markets. Global leaders is looking, I mean, they are looking at global. So they do have a little bit, they have a couple names. I think they own a bank in India. They have owned Tencent in the past. I don't believe they own it anymore, but very, very few kind of true emerging market names. Most of those names are kind of global from a revenue basis. Part of that portfolio is US. So if you think about kind of the makeup, if you think about the global kind of market, stock market, 50% kind of being kind of US, and then the rest kind of the rest of the world. And so I would say and they think about things not just from a kind of country of origin, but they also look at things on a revenue basis. So where is the revenue being derived from within those individual companies? And so they look at it kind of from a multiple, from different perspectives in the global. But what they have is they have the ability to find value any place kind of on the planet, which gives them a unique mandate, which most managers, if you think of Flex, like they're only looking at large cap US companies, right? So what they can own is a very small subset. And the same thing with the emerging market managers, the ones that emerging Asia manager, they only can own Asia companies, Asia growth companies. That's their mandate. So yeah, hopefully that's a bit more helpful.
So sticking with the equities portion of the portfolio, do you recommend changes to anything here, swapping anything out, adding, subtracting?
No, I think right now, I think more than ever, right? It's about just owning really high quality businesses. And I've said this before, we are in a somewhat of an uncertain time. Just to be quite honest, it's a tough market. The market has sold off earlier, into this, last meeting with the Fed yesterday. And I think there's just uncertainty. Rates are going to rise. The market's pricing in 3 interest rate hikes this year. A lot of that's already been priced into the market. I think it's been quite well telegraphed by markets, which is a good thing. And I think Chairman Powell kind of made reference to that in his talk yesterday. But the market kind of heard it loud and clear. And kind of what does that mean, right? I can say that, and that's, what does that mean for kind of your portfolio, and how do I kind of relate it to that? If you think about kind of what do those interest rate hikes mean kind of for the broader? Well, money's been cheap, right? We've been in this very accommodative environment, over the last few years, and money's been cheap, money's been easy to get, and so a lot of these kind of early stage businesses or kind of secular businesses that are really kind of innovating and have a lot of future gain. People were just bidding up those stocks for the last 2 years, where they had no earnings, sometimes no sales, and the price to sales on some of these, or the price to earnings, really they had no earnings, so the price of sales was through the roof. And so when interest rates and the price of money starts to go up, well, then the multiple, what people are willing to pay on stocks, comes down. And so you've seen this re-rating across the board. In the NASDAQ, just using kind of one exchange, the NASDAQ, 50% of NASDAQ companies over the last 5 months have fallen 50% from their highs. So there has been a lot of the froth has come out of the market. There's still some froth in the market, but a company like Shopify, who is growing earnings like crazy, has gone from, and that's a large cap company, really feeding into the secular growth of new businesses, e-commerce. It's feeding into all the things that the market loves, but it's gone from $1,600 down to $850 a share. And it's back to where it was in July of 2020. And so the market sold off. And I think what we're seeing and kind of what our expectations are is a lot of these really high quality businesses that have sold off significantly are still producing good earnings. And we're likely to see good earnings calls, and we're in the middle of earnings season right now. Where you look at Workday today and Blackstone, two really good businesses that have had meaningful sell-offs, we're both up today, 8 to 10%, because they've had knockout earnings, and their forecast going ahead are really good. And so those companies with good earnings are going to be rewarded. So high quality businesses, good growing cash flow, those companies are going to be fine. It's a lot of the froth and no earnings that have really meaningfully sold off and probably will, remain at depressed prices. None of which we own in the portfolio.
Right. And this may be sort of foreshadowing our discussion about allocation, but is the market at this point oversold in your view, and maybe it's time to jump back in to try to capitalize on those high quality companies?
Yeah, I mean, we were buying, we were buying on Monday. I mean, if anyone's watched the market this week, it's been a whipsaw, kind of some highs and some lows, and it's been a wild place. But I mean, look, the RSI, the relative strength index, was down around 19 on Monday at its lows, and the market was down 2.5%, 3%, more than that at times. And so I was buying. I mean, I was a buyer, right? I mean, it was the relative strength index was lower than it was back in March of 2020 during the pandemic. So it's kind of like setting up the signals, like they're setting up the buy signals. And so, where I had cash to put to work for clients, I mean, I was in the market, I was buying. I wasn't buying a lot, but I was, certainly recognizing an opportunity. And clearly I wasn't the only one, because it went from, down 4% to like up 1% in a single day. It was a massive swing. But I think everyone else kind of saw that as well. And so I think, there are going to be moments here to be a buyer for sure.
Okay. Let me shift gears quickly then to the fixed income portion of it. You're basically tracking the index, so that's always positive. Obviously, fixed income is not performing, and that may get worse as rates rise. So what's your view on what to do with this segment? Do we need a different kind of fixed income, or do you think this is more a question of allocation, whether we allocate it to fixed income versus equities?
Yeah, I mean, it's probably more allocation. I mean, it's a whole lot of fixed and very little income right now, and that's the tough part.
Yeah, and relative to inflation, it's negative. So
right, exactly. So I mean, look, we're having lots of these conversations, and it all comes back to, do you need this money, right? Like, does the town need this? What are the events that you would need this money for? Can you take on more risk with equity, with additional kind of equity exposure, or having a little bit of real estate exposure? Because like, it will come back. I mean, it will normalize. I mean, bonds will be rolling off, and they'll be bringing in new bonds with that are being new issuances that are coming out with higher coupons. I mean, it's an active strategy, right? So it's not a kind of a set it and forget it type of strategy. So they're going to be making moves within the portfolio to keep up and hopefully kind of beat the benchmark as rates rise. Duration on this portfolio is about 4 years. So definitely less than the Barclays Ag and underweight their intermediate Ag Barclays or Bloomberg Intermediate Ag Index. It's hard, right? I mean, we do have guardrails in which we can kind of go that we have to stay within. And so, if you all tell me and the committee makes the decision to do something different, then we'll certainly put the proposal together to do something different. I just don't think there's a lot of places to go within fixed income right now without taking on added risk. And I think that's just where we're at the moment.
So essentially nowhere to hide within fixed income.
Unfortunately, no.
Got it. Okay. Well, I've monopolized the time. Let me open it up to the floor. Other committee members, any questions, comments?
Hey, Brian.
Yep. Commissioner Persinger.
Yes, Gary Persinger. Just a quick note. The mayor dropped off the call because we realized our FOIA monitor realized that with 3 commissioners on the call, we couldn't say anything. So
okay.
At least either Elizabeth or I will have an opportunity to say something at this point.
Okay. Very good. Thank you.
Mm-hmm.
Nothing from the committee members. Any of our other guests, either commissioners, wish to ask any questions of Dominic? Okay, why don't we?
I have one
Let me throw something out there.
Sure.
Dominic, you mentioned that you've been having these active discussions with others. What has been the most frequently come to conclusion that you've had, if any? I'm just, I'm looking at this with the same eyes as Brian, and just, we're probably going to take a hit with something. Are people moving to things like tips or something else that, again, might
Not really.
users, but aren't going to be, they're still going to be hit by inflation or
Yeah, I mean, look, it's a tough. I mean, I'm not going to sugarcoat it, right? I mean, but the bond market's not going to, we're in high quality investment grade bonds, right? Like as high quality as we can get, that's where we're at. And so, yes, in the short term, as rates rise, will you see a little bit of volatility? Yeah, you're going to, but we're maintaining that high credit quality. And at the end of the day, I think that's what's most important. We're not taking any significant risk where we're going to see a lot harsher downside, and we'll make up for it over time, right? Like it will make up from yield and from updating the portfolio. You will make that up over time. And so, yes, you might have a little bit of decline in the short term as rates start to rise fairly quickly. But, I think I've been on within our fixed income team, the guy who runs this portfolio. I've been on the phone with him twice in the past 3 days. And, he still had all the confidence. I mean, he's like, look, in the short term, you'll have some volatility, but at the end of the day, you're in this particular strategy because you're looking for high quality credits with good businesses that we're underwriting from the bottoms up, right? And so, if we're going to be anywhere, I like where we're at today. We're not taking any credit risk. We're not taking any kind of undue risk to this portfolio, and I think that feels good for right here, right? I think we can all live with a little bit of pullback in the bond market. If we put something in more of an unconstrained, more of a credit strategy, and we're down 15%, that wouldn't feel too good, right? Like that's not really where we want to be, nor would it be within, to be honest with you, nor would it be within our in the investment policy statement. So we're a little bit constrained with what we can do, but even if we could do more, I don't think there's a ton to do. I mean, we could go a little bit shorter duration. We could maybe take some out and roll some, as rates rise, roll some T-bills as a part of the strategy. I mean, we can do something like that in the short term, but I'm honestly pretty comfortable with what we have today after those two calls with the portfolio manager.
Okay, thank you.
Any other questions or comments?
Yes,
Okay,
Dennis, were you going to say
Oh.
something? Yeah.
oh, go ahead, Dennis.
I was just going to ask about the utilities. Are we in any utilities one way or another through one of the managed portfolios? They pay a higher dividend or interest. They're almost like bonds in a way.
Not directly. I mean, we're I can take a look at let's see if we have anything. So we do, like I said, we do have one energy name in this portfolio. I don't think they own any utilities. They own some tower companies, which also have good yield. Crown Castle International's 2.8% yield. So there is some yield component to the portfolio, to that flexible equity portfolio. But again, they're looking to buy long-term companies, long-term businesses. They're not looking at short-term. So that's just their philosophy, and they're looking at it from a total return approach. And so if a stock is paying a dividend, that's a bonus. But not looking at it from we can certainly look to add a value or a dividend type of strategy. I mean, we have those that we can add to the portfolio. But at the end of the day, I mean the track record of Flex and what they've been able to provide, over the last, not only this period, but the last, honestly, 25 years has been terrific. And so I like keeping things quite concentrated. And that is a good diversified US large cap strategy that's very well balanced between growth and value. Yes, we could do that, Dennis, no doubt. We could add some dividend strategies to it, but yeah, if they see value in the utility, then they would purchase that within the strategy.
Okay. Okay.
I'll just note for the record, it looks like we lost Mike Schaefer's connection, but we still have a quorum, so we can continue, and hopefully he'll dial back in. Just to follow up on, oh, there he is, he's back. Just to follow up on that last question about the utilities or value strategies, is that a reasonable substitute for part of the fixed income portion of the portfolio, or?
That's what I was thinking. That's what I was thinking.
I'm trying to look at, so I actually did add that too. So this was the proposal kind of that we had talked about. And so part of that was to add a dividend growth strategy to the portfolio. So we have a strategy, Wellington Dividend Growth, that focus on companies that are growing their dividends. So a little bit more of a value strategy, kind of pairing that with the flexible equity strategy. And then so taking some to go there, and then some to go into real estate, which is, the Blackstone real estate is like 5, I think right now it's 4.5 to 5% kind of cash yield, which is quite good, with a very, 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 very seasoned team. So we've been using that as kind of a fixed income substitute where we can actually get yield, and we're in an asset class that is somewhat inflation protected, with a high quality team. And so that's kind of how we've been kind of thinking about that. And then we've been adding some value. So if you see here too, we have another international kind of more of an IFA manager, that is very value focused. And so we've been kind of adding that to portfolios at the moment. So that's kind of why I put that proposal. So slightly different, not just going kind of straight equity, really thinking about it from a diversification and where we are today. And then kind of what would we change to kind of substitute that fixed income with not taking on kind of a lot more risk in the portfolio. So the Blackstone fund has done really well, and it's been really great for our clients thus far.
Why don't you go ahead and take us through the proposal?
Yeah, absolutely. So this is the portfolio as it is today, and kind of with thinking about kind of, again, the bottom stats here are really thinking about kind of forward our thoughts on each asset class, the return profile of each of those asset classes, and what would how would the portfolio perform over the next 10-year period. And so it's their estimates. There's no certainty here, but it's a framework that helps us kind of build a portfolio. So this is kind of how things are positioned today according to your IPS. And so if you look at kind of the overall kind of annualized return profile of this going forward is about 3%. There is, based on kind of being active managers and how we have positioned, about 0.5% of kind of alpha generation on top of that. So if you think kind of total return of 3.5% is kind of the forward projection for this portfolio. And with a 10-year cumulative return of 4.2%. And during a kind of a moderate kind of 1 in 10 year drawdown, the portfolio would draw down, around 5% during that time. So kind of switching gears and kind of what we would think to do, or what our recommendation would be, just based on how we see the markets kind of moving forward, reducing that overall fixed income exposure. So kind of going from a 75% fixed income down to roughly kind of, that's fixed income and cash, down to about 40% kind of fixed income and cash, adding to large cap US equity, adding a little bit to international, adding a smidge to emerging markets, but really adding the most, really adding a new asset class in real estate. So a little bit about that real estate investment. I know we talked about liquidity earlier, Bill. So this is a little bit more illiquid. However, they have a really accommodative strategy. So it's not publicly traded, so you can't go and buy it on an exchange. So you don't get that day-to-day volatility, which is really good. From a reporting standpoint, it's 1099 reporting. It's invested in, really high quality industrial, multifamily, a little bit of office and retail, but very small portion of the portfolio are in those asset classes. The asset classes in which we think have a lot of tailwinds kind of in this market, given kind of the undersupply of kind of housing throughout the United States. The increase in need for industrial space. If you think about kind of all logistics and e-commerce and how that's kind of taken over pretty much everything we do. And so, we like the profile and the makeup of it. It's a 1 year, so it's a 1 year hard lockup, and then monthly liquidity after that. So it's good liquidity terms kind of moving forward. And so it's not like you're locking your money up and you can't get it out for 10 years. It has a small lockup at the front end and then kind of monthly liquidity after that. It's producing 5% cash yield. It's an evergreen fund, so you're going to get that on day one. And then last year we target it to be kind of a 9 to 10% total return type of strategy. Last year it was up 30%, as a lot of real estate, as we all know. As we all know, real estate was up a lot last year across the board. So it's a really good strategy. I mean, it's the best team that BlackRock has. It is a growing strategy, and we're looking for others like it. And so we have a search out for similar structures. It's really good for our not relevant here, but really good for our taxable clients because it's a 1099 reporting. There's no K1 for it, which is really, really good for taxable clients. And so it kind of fits the need. And you don't have to be a qualified purchaser, accredited investor. Anyone that has a relationship with us can invest in in this strategy. So I'll stop there and just kind of open it up and see what obviously this is just a proposal. This can change, but this is just a kind of a first draft to just kind of get the conversation going, and we can kind of iterate from here.
Well, let me start with the real estate fund. I like the idea of it. I think one immediate concern with it is the lockup because we're giving up liquidity. So for the first year, we would have to treat it as totally illiquid. Then thereafter, monthly liquidity is still essentially illiquid for all intents and purposes. So it's a fairly sizable segment. 10% of the portfolio would be basically deemed illiquid.
Yeah, it is. I would say we definitely use a lot of illiquid investments. People come to Brown Advisory for our private and illiquid investment access. It's a big part of who we are and what we've built because of our access. So we have a lot of other illiquid investments that quite frankly we can invest in just because of the size. And so this is we can invest in REITs. We're not big on REITs, but we have some real estate investment trust options that we could invest in. We're not a big fan just because of the correlation to the equity market that REITs do have, but that is an option, and we can size that down. We can make it 5%, right? Again, this is open for discussion, and we can make it 5% in BREIT and 5% in a REIT strategy, that has daily liquidity, right? And we could pair it with something like that just to kind of balance it out a little bit and get everyone comfortable.
Yeah, I don't think our investment guidelines put a restriction on liquidity in the long-term portfolio the way it does in the short term. There's no cash requirement for the long-term portfolio. But I think it would have to be judged relative to the needs of the town. if we're already in sort of a shortfall position relative, at least for the rainy day fund, we need to, it sounds like, replenish it or add to it. And I don't know if we're in a position to be holding anything illiquid. Commissioner Persinger?
Yeah, a couple of comments on that. I'm not, supporting or opposed to this proposed real estate allocation, but in terms of liquidity and our fund balance policy, under the current budget year, the rainy day fund is $1.8 million. We also have an unassigned balance of $540,000. That said, what we're looking at right now is a budget surplus of somewhere around $1.9 million. What we will have to do is to take some of that money and to add to the rainy day fund and also the unassigned fund balance as of the end of this fiscal year, going forward into the next fiscal year. So we actually only have to increase the rainy day fund up to just over $2 million because we have to have in that fund 6 months of operating expenditures. We can take out of that budget total of about $4.5 million, somewhere around $300,000 and $350,000 in the set aside money. This is money that comes from the hotel tax, that goes to capital improvements, money from building permits that goes to the infrastructure account. So there's about $350,000 of that. So when you take that out, it comes down to a little over $2 million. We'll have to increase our unassigned balance to about $625,000. That's still going to leave us with a fair amount of money that I think we're going to allocate either to, or maybe a combination of, the infrastructure account and capital improvements. None of this has been approved by the commissioners yet, but that seems to be a likely strategy. So in terms of liquidity, the unassigned fund balance, which will be about $625,000, that's kind of the first place you look to if there are any short-term problems with revenues or operating expenses. And the rainy day fund is really there to provide some backup in case there's some catastrophic needs that we need to address. So, in terms of the long-term portfolio, which is, and we're talking just about the beach fund here, it's kind of down the list in terms of liquidity needs, I think. So just a comment.
Okay, so if I understand that correctly, so the unassigned balance currently sits at $540K. It needs to go up to about $625.
That's right.
So there's a shortfall of $85,000 there. The rainy day fund is currently at $1.8 million. It needs to go up to $2.25. So there's a shortfall of $425,000 in that fund.
It's really just over $2 million. I think probably $2,050,000.
Okay, so we're really shortfall of about $275, somewhere in there.
Well, but those shortfalls will be satisfied by using money that's in the excess funds that we have for this budget year. So that will not be a problem. We'll still have money left over that we can then reallocate to infrastructure and to capital improvements.
Okay. So essentially for very short-term needs, there's the operating budget, there's the unassigned account, and the rainy day fund. All of those needs are being met by the current budget.
Right.
Okay. So that gives us a lot more flexibility than in the long-term account.
Yeah. And just one other comment, the $1.4 million position that we have with Brown, which is, I think, 60% fixed income and about 40% cash, that is the lion's share of our rainy day fund. Just to be clear. And
Okay.
we haven't really talked about it. Everything you've been talking about so far, I believe, is just the beach fund.
Yeah,
Got it.
that's correct.
And is the balances, the name just went out of my head. The short-term operating funds are at a bank.
The unassigned balance, I believe, is with Fulton. Is that
Fulton
right,
Bank.
Shannon?
Yeah. Okay, so
1.4.
Fulton has the unassigned account. The rainy day fund is essentially the short-term account at Brown. And is there anything else? We have the long-term, the beach fund at Brown, and that's it?
Yeah, part of the rainy day fund is also in cash that's held at Fulton, I believe.
Okay.
I'm assuming that's the right bank. It may be a different bank, but I think it's Fulton.
It is Fulton Bank.
Okay.
Well, I think, I mean, Brian, I happy to, answer questions, but, I think this was really just to kind of start a conversation, right? I mean, about, different changes we would make if that just kind of came out of our last discussion.
Yeah.
So, it's not going to happen overnight. I know that. I know there's obviously changes that have to get passed, and it's not a quick process, but happy to kind of, if you all have conversations and want me to provide more additional information or get back on and walk through it, I'm happy to do so. Again, really the biggest change was really adding illiquid real estate. I mean, at the end of the day, it's bringing down your fixed income allocation and adding kind of a new asset class. So it's kind of getting comfortable around that.
Comparing the current versus the proposed side by side, I mean, you're essentially going from roughly 75% being in cash and fixed income down to about 40. And you think that will capture returns going from, I think it was about 3.5% to up to about 5%.
That's correct.
So, I mean, you're picking up almost 50% more returns projected, of course.
Sure.
But projecting the returns to be better by simply reducing the fixed income component.
Yeah. Yep.
And obviously, I think the real estate's a pretty interesting add to the portfolio. I think we'll have to discuss as a committee the liquidity issue, but obviously we can swap that out for something different if the committee's not happy with the illiquidity.
Yeah.
Okay.
Yeah. Yep.
I think that's great. And your next slide, I think, was just as
it was just a kind of, just sometimes it's nice to just see the visual, see the additional colors on the portfolio.
So it's reducing principally the fixed income green.
That's correct.
Cutting it almost in half. Okay. Any other questions, comments for Dominic? Anyone else on the committee?
Yeah, this is Bernie. For Brown, I've had it for about a little over a year now, and it's done really well. So I think it's the recommendation for Blackstone rather is good. So
okay, yeah.
Yeah, I very much like the idea, Dominic. To me, it really just comes down to the liquidity question.
Totally understand. Yeah, totally. That's what I say. It's about getting comfortable. You guys let me know, and by the time we talk next, I mean, we might have another option. So it comes down to the yield, right? It comes down to that yield component, and you're not going to get much from a publicly traded REIT that's going to get you steady 5% without any market volatility.
Mm-hmm.
Without market volatility, I should say. So that's kind of where but then again, you could, we own this Blackstone, the stock, which has done really well. So you can imagine they've had obviously inflows with this. It's been a really popular structure, right? Because everyone's searching for yield. Like, we're just in this environment where everyone knows what fixed income is doing, and which is not much, as we talked about. And so they're looking for alternatives. They're, we're talking about inflation and how long is it going to persist, and how can we get some yield? It's a little bit more of a risk, it's a little higher risk profile in real estate than fixed income. Certainly, you have to worry about liquidity, but at the end of the day, you're investing, and you got to invest in the right, and with the right teams. And so we think they have one of the best in class kind of teams out there. So
just curiously, with that Blackstone fund, do you know how it performed like in different market cycles? So even just in early 2020, was it still performing well?
Yeah, I think I just looked at the 5-year number, which is the furthest back. The 5-year number, I think it was up 15% on an annualized basis over the last 5 years. So it's annualized at like 15% total return. Yeah.
Yeah, Brian, just to put in perspective, it took me like over 6 months before I actually could accept the fact, all right, it's a good investment.
Yeah, I mean, those are pretty rock solid performance numbers. So
Yeah, no, we definitely, we looked at a lot of different options, and that's kind of where the team has landed. We've got some other things out there. I'll definitely take a look around. I'm just sensitive to kind of what the investment policy states today. But I mean, as far as different types of kind of asset classes, and we have an infrastructure fund. We have an MLP fund, which I don't really like that much. We have another globally listed real estate fund that I've used here and there. But I mean, overall, that Blackstone fund has performed, just far and beyond any of those other options. So, all right.
If no other questions for Dominic, I think we can let him drop off, and we'll move on to our next topic, which is the investment policy and allocations.
Great. Well, thank you, everyone. Have a great evening.
Thanks very much, Dominic. Much appreciated.
Bye-bye. Bye.
So I think the next topic is to discuss the investment allocations and risks. And the mayor had asked a question of, whether we should treat these accounts as separate accounts. Do we want them to be combined for sake of simplicity? But I think the real meaty question is the investment allocations themselves. I mean, setting aside whether you blend accounts together or not, I'm not sure it's going to make a huge difference in our lives. But the allocations between long-term and short-term, I think, and what's allowed in those investments is something that is definitely worthy of discussion, particularly for the reasons we just discussed with Dominic, that the fixed income portion of the portfolio is really going to struggle. And we may want to kind of move things around a little bit to make some changes. So making sure we finish off items on the agenda. Item 6, we completed the portfolio review. We've had questions from members. I think we've seen the new implementation. The last item under 6 is to discuss and possibly vote on new possible investments within the policy guidelines. In my view, and I will open it up to the floor, in my view, I don't see the need to make changes based on this discussion insofar as our existing investment policy guidelines. We'll come to a moment in just a moment whether we should make changes to those guidelines or not. But based on what the current restrictions are, I think the investments have performed pretty well. Particularly the equity portion of the portfolio, and I mean they're keeping pace with their benchmark on the fixed income portion. And I did not hear from Dominic any sense that we need to swap out investments or that there are much better alternatives out there. But I welcome input from the rest of the committee. Does anybody feel that we should be recommending changes to the current investments? And I'll invite our commissioners if there's any additional commentary from the commissioners.
Not for me, no.
Okay. I'm not sure that we need to vote on keeping it the same. So I think we can move on and move on to the next item in our agenda. I think based on no further input from the committee on this issue, I would recommend that we just keep the current investments as they are within the guidelines. But the next item on our agenda is to discuss the allocations and the risks and potentially recommend changes to the investment policy itself. Let me pull that up and see if I can share my screen. This works. Let's see. Hopefully I'm getting the right one. All right. So this is the investment policy that we have recently adopted or adopted amendments to it to clean it up. The question before us now is whether these are the appropriate allocations among the accounts or whether we would recommend changes. So the policy applies, as you can see, to the general fund, which is short-term, and then the beach replenishment fund has a short and a long-term component. I think the real issues get down to these allocations. So you can see on the short-term component, this is the current allocation ranges. Equities would be 0 for the short-term fund, and then there's a blend between fixed income and cash. The range allows us to split the fixed income all the way up to 80% and cash down to 20%. But in my view, short-term needs need to be the most highly liquid and least volatile. My personal opinion is if we were to make a change here and allow equities in the portfolio, it would be to gain a little bit of exposure to get potential returns. But that's at the expense of taking on some risk because you can have downside risk. I personally would probably not recommend that we import equities into this short-term component. But if we did, I would recommend we not exceed more than 5 or even maybe 10% of the portfolio. But I invite the other committee members to share their views on that.
When you say equities, are you talking about mutual funds or ETFs, or are you talking about specific stocks?
Well, I suppose we could do either. The definition of allowable assets within the equities is actually defined in the long-term portion of the investment policy. So that's this paragraph here. And it allows you to invest in really anything that's an equity. So that could be stocks. As you can see from our portfolio, we're not investing in any individual issues. We're only investing in funds. So that would be your mutual funds, exchange traded funds, and the like. And they can be actively managed. We do have an actively managed portfolio, as you can see from Dominic's discussion of their selection of managers. So, I think we would use the same definition of equities that we're using for the long term. If we allowed it in the short term portfolio, I would say we should use the identical definition. Mm-hmm. But really, it kind of comes down to this line right here. We currently have 0 in equities in the short term portfolio. Do we want to open that range up to allow any equities in the portfolio? Again, you may get higher returns, and there are some types of equities that are more, they resemble more of a fixed income type instrument. We were discussing utilities or possibly a value-oriented fund that's focused on dividends. So that may resemble the performance of an equity, I'm sorry, of a fixed income instrument has more of a, a dividend payment or a coupon interest, and tends to be much less volatile in price. That said, those kinds of investments, they're still equities, they're still stocks. They can change in value. And in a short-term portfolio, we'd have to do that with eyes wide open, that, if there are short-term needs, it's highly liquid, but the price can be volatile. So, you may be able to liquidate it on, instant notice, but the value of it may have gone up or down since the last time you looked at it. Whereas fixed income doesn't tend to fluctuate quite as much. So I think the question remains to the rest of the committee: do you think we should allow for any equities in the short-term component? And just further food for thought, we could set a range of 0 to say 5% or 0 to 10%. I personally would not go over 10%. But we can put the range in to allow it, but still recommend to Dominic that he keep it at 0, but allow for the flexibility. I mean, that's yet another option.
What do most governments, local governments do? Or do you know?
I don't know. We can ask Dominic for his view of comparable clients, but beyond that, I don't know.
Yeah. I personally, I would like to see some inequities. However, if no other local government wants to do this, I wouldn't do it, But I'm a big, I don't want to say, I had a Series 7 and 24 and all that stuff, so I'm talking like that. I've also been involved with nonprofits, and nonprofits normally don't have any equities. So you don't want them, they're dangerous.
Yeah, I mean, I like the idea of using equities in a modest amount to try to counterbalance or, counteract some of the degradation in the fixed income market. I mean, at the end of the day, right now, we're losing money in fixed income investments. And that's because interest rates are rising, as Dominic explained, hence prices are falling. So the current instruments that we hold are losing value that way. As he noted, portfolio turnover allows you to recapture some of that. You end up buying new instruments at a lower price and get the higher yield. So it shouldn't be catastrophic, but we're probably losing a little bit. But also simultaneously, we're in an inflationary environment. So anytime your earnings are trailing inflation, you're losing as well. So, having instruments that pay pretty much close to 0, or even slightly below 0, plus adding inflation on top of that, makes fixed income not a very attractive place to be. And that might be a reason to consider allowing a little bit of equities into this portion of the portfolio. But again,
Yeah.
I think we just have to be mindful that those are much more volatile investments.
And there are equities that have a history of raising their dividends every year, and they're very stable companies.
Yeah. And there are a number of funds out there that do nothing but invest in dividend producing stocks and are value focused. But even dividend focused investments can still go down in value.
Correct.
There's really simply no way to insulate yourself from the vagaries of the market. And even the most stable utility paying a coupon of X% a year can still lose a little bit of its value in the stock price. And there's really no controlling for that. So I think it still comes back to the same question of, are we willing to take on the added risk that certainly in a short term value for any given investment is more likely to go down in equities, or is at greater risk of going down with equities, but counterbalanced with potential for higher returns.
Well, there are managed funds that specifically will pick stocks that are not very volatile, that pay good dividends. And like when they're not going to run up high like the market has, but they're a very solid stock. They're not going to lose much either.
Right.
And historically, they've done pretty well compared to our fixed income anyway. We're just talking 5%. I'm sure Brown Advisors has a few of these managed funds.
Oh, I'm certain of it. And there are many products on the market that are, you don't have to have any special access to a manager. I mean, there are pretty good ETFs that are value-oriented ETFs or mutual funds that can be purchased by anyone. And, that's precisely what they focus on. They're definitely driven by dividends or income, but they happen to be equities as opposed to bonds. We can certainly consider also restraining, if we wanted equities, we could also restrain the types of equities that are in this portion of the portfolio.
So I just went back and looked at some of our notes, and in two of the meetings this year, or last year rather, we discussed examples of funds like the Vanguard Fund. So we've kicked this idea around more than once.
Yep. Yeah, we've come back to this several times. We've not deviated from the 0%. I think it's, we either make a change or we don't. We can keep talking about it. Perhaps it makes sense to invite the commissioners to give their views on the needs for short term as well as the town manager. What does, from your perspective as commissioners or as the town manager, does it worry you to have a portion of the portfolio exposed for short term, exposed to more volatility? If we were to say as much as 10% of the short-term component could be invested in equities, are you comfortable with the risk that 10% of the portfolio could go to zero? That's how I look at it.
Yeah, this is Gary Persinger. How big is our short-term portion of the beach fund? I was just looking for that quickly.
Let's see if I can.
It looks like it's probably somewhere around 3.6, 3.7.
That sounds about right.
Yeah. So it's really a sizable portion of the. We've got 3.6 right now in fixed income, which isn't doing very well. In terms of the commissioners, the implementation strategy that's in front of all of you now was approved by a set of commissioners completely different than what we have today. So we as a set of commissioners have not spent any time talking about this element of risk. We've been trying to get the house in order in terms of our general fund balance policy as recommended by the auditors, and we think we've done that now. We had a great budget year, and so that's given us the opportunity to set up some funds and increase some other funding that we haven't been able to in the past. We now have a capital improvement fund. We didn't have one last year. We now have a good infrastructure account. We'll never have enough money in either of those, but at least we're doing fairly well with those. I don't have an answer on liquidity. You guys have one of your suggestions was maybe to allow it, but be very conservative about it, both in terms of the size of the allocation as well as the potential volatility of what type of investment may be used there. So, as you say, you have to make a decision. You guys have to come to a conclusion in terms of a recommendation. And then we need to kick it around among the 5 commissioners and see how comfortable we are with exposing this short-term component to, potentially, well, actually, we're talking about the short-term component. What I was looking at was the long-term. So,
yeah, it looks like Commissioner Persinger from the summary, the beach short component is a little over 200,000.
okay.
The general fund is $1.4 million, give or take.
So there were options there, but again, the $1.4 million is the lion's share of our rainy day fund.
Okay, so that, in my view, quite simply would be we don't touch it. I mean, I don't feel that strongly about trying to increase returns on something that is really genuinely a short-term need.
Well, the question is that the short-term need? When we set this up, our intention was to have the unassigned fund balance to satisfy any of the short-term issues that we might be faced with.
I see, and that's the portion that's at Fulton Bank.
That's at Fulton Bank.
I see. Okay.
And then the other, the $1.8 million currently in the rainy day fund, there's $1.4 million at Brown and another $400,000 at Fulton Bank. So, I think as we were putting this together, we thought that there might be some increased flexibility with respect to the $1.4 million. Certainly not to go, get outlandish with it, but, we thought that there might be some opportunity. And originally I was thinking more about fixed income than I was about going into equities. But, fixed income clearly is not a good option right now, certainly to increase the position there. Again, it comes down to you guys making a decision. Do you want to increase some flexibility in the portfolio, but be very cautious about it and let us kick it around, or you want to leave things as it is? And, I can't tell you which way to go here, but it's up to you guys to make a recommendation to us.
And I don't have much to add to what Gary has said, because all of this is new information for me. And so I don't know that I would be able to provide any guidance. I tend to be risk averse, but that also doesn't get you much gain.
Yep. Well, I from my standpoint, as I said, I probably, for a short-term component, as long as the money is properly parked in the right funds. I mean, that's a whole different question, and I leave that to the council. But it's certainly conceivable that we have money sitting in a short-term account that doesn't even belong in a short-term account. It maybe is better served being moved to a long-term account. But I don't think that's the province of this committee to make that judgment. We take at face value that the funds are allocated or deposited rather in the proper account, short-term versus long-term. Within the short-term component, my view is I probably would not recommend anything more than, say, 10% being opened up or exposed to equities. Because philosophically, I think a short-term fund should have it should be a fixed income focus. But I do believe that we can get some modest additional return. We can moderate the risk by curtailing what kinds of equities would be permissible. Give direction to the investment advisor, Dominic at Brown, and keep it focused on value type investments, income producing equities. So I'm comfortable going up to 10%. I probably would not vote for more than that at this point, but I open that up again to the rest of the committee.
I agree with that. This is Dennis. And also I'm sure that Brown Advisory has these more conservative type. I was one myself at like when the market was going crazy. I was saying, why am I in this conservative fund?
Yep.
But it did so wonderful, and it's actually done wonderful beyond that now. But I always knew I was getting a certain return, and I was getting a great return.
Yep.
Not a great compared to what we're getting. I mean, I was getting a great return with very little risk. I mean, when I say that, the companies were like Johnson and Johnson and things like that.
Mhm.
And,
I'm comfortable with 10% as well.
Okay.
And one of the things that I have heard said is that we have short term, and then we have, which means like immediate, and then we have short term, which really means middle term, and then we have long term. And so as long as we have the immediate need, then I am less adverse to it.
Yeah, and I agree with that, Commissioner. I think Commissioner Persinger put my concern at ease, which is that Fulton Bank has the genuine, like true, really immediate short-term need funding is sitting there. And the rest of this, although short-term is maybe, short is in the eye of the beholder, may not be called upon in the short term the way that the money at Fulton Bank would be.
Yes.
Okay, I think we're probably settled on this question. What I will propose to the group to do, and we can take a vote on this at the end, is that we adjust the short-term component to allow equities in a 0 to 10% range. The fixed income, I think we can actually leave the ranges for the other two the same, and
they're very wide, yeah.
yeah, I mean, they're pretty wide ranges. So even if you got to 10% in equities, you still could allocate to the other buckets as needed to keep it at 100%. In terms of the allowable assets, my recommendation would be that we pick the definition from equities that is down in the long-term component, but we add additional restraints, which would be that they be value focused or income producing equities. And I would be happy to develop some language that I would present for a vote at the next meeting, if that's consistent with the rest of the committee's views. That leaves us with a discussion on the long-term component. And I think this portion, as you can see on the screen, the ranges allow for equities up to only 35%, and fixed income has a minimum of 65%. Currently, we're sitting higher than that. As you'll recall from Dominic's presentation, we're a little bit over 70, I think it was 72% between fixed income and cash right now. He showed us a proposal that would have reduced the fixed income and cash component down to 40%. And that would be a blend of fixed income being 30-something% and cash being, I think it was 37% in fixed income and 3% in cash. And then the balance of the portfolio, the other 60%, allocated among a bunch of different equity classes, including that real estate fund. If we were to do that, we would need to do a couple things with this. We would have to expand the allowable range of equities so that it could go up to, as he proposed, it would be 60%. I think we would want to even give a cushion a little higher than that if that's the range we really want to work with. That would be number one. And then number two, I think we would have to open up the definition of equities to include closed-end or private investments that are potentially illiquid, because there are, implicit in these guidelines are liquidity restraints. I There's no restriction in the liquidity paragraph on actually having or having illiquid investments. But I think we should be explicit about that, at least for no other reason than the public should know if we are opening the portfolio up to a portion that could be invested in an illiquid investment. And for the benefit of the group, when I say illiquid, the general definition in the securities industry is that something is deemed illiquid if it cannot be converted to cash reliably within 7 days. So any investment that is locked up, like the Blackstone fund that Dominic had recommended, would be by definition considered to be illiquid, because for the first year you can't withdraw the money at all. And then after that, he said it would have monthly redemptions, meaning you can only once a month on the dates prescribed by the fund withdraw your money. So that by definition means you'll never have better than 30 days of the 30-day ability to convert to cash. So that sort of investment is by definition illiquid. It doesn't mean you can never get your money out. It just means that you have to wait for it. Personally, as a longtime investor and working in the industry, I believe quite strongly in making investments in illiquid holdings for the very reasons that they tend to have much stronger returns. If you're operating a big real estate fund like the one that Dominic proposed at Blackstone, you don't want shareholders to be able to pull money in and out on a daily basis because you're trying to make very large long-term investments when you're buying big office buildings or big industrial plants or whatnot. You have to have the flexibility as a manager to lock up money into investments, which is why those kinds of funds are structured the way that they are. And I think those are the kinds of investments where you typically will find better returns, but you have to recognize that they don't come with easy withdrawals. You really are committing to them for the long term. I think that sort of investment is appropriate in a long-term portfolio, but I think it also has to be limited. Obviously, we don't want 100% of the long-term portfolio locked up in that sort of investment. Personally, I am comfortable allocating a portion of the portfolio, and I would probably not exceed, give or take, 10%. I could be persuaded that it could be a little bit higher, but probably not much higher. In my view, I don't think the interests of the town are well served by having even long-term investments truly locked up like that. So I would limit it. But again, open it up to the rest of the committee if there are any views on these two topics. One, should we change the range of allowable equities currently sitting at 35%? Should we ratchet that up? And then second question is, notwithstanding or irrespective of that, do we want to open up the definition of equities to include illiquid investments and real estate investments in particular? And again, with the caveat that we can open the portfolio to it, but we're not obligated to actually invest in those things either. But it would add flexibility to the investing style of the account.
Yeah, I'll go. I like the real estate component in a limited format, like you mentioned. And I think 10% seems reasonable. And as far as the 35% mix, I do think we need more flexibility. I don't know what the right numbers are, but I sort of feel like we're approaching the fund with a conservative standpoint from an individual investor who's looking to make sure they've got a certain amount in the bank for their retirement. And the city doesn't, I don't know if they view this fund the same way, since we're not exactly sure if the beach replenishment fund is actually ever going to be utilized for that. It's sort of got the timeline for its ultimate use is a little further out. It seems like we could conceivably be a little bit more aggressive, but I don't think that's for us to determine. But I'd like a little bit more flexibility, and I like the real estate, and I think 10% is a reasonable small risk to take.
Okay. Thank you, Mike. Any other comments from the committee? And with respect to the range, I mean, I've always viewed the long-term account as being too conservative. I look at a town or a municipality as having an infinite time horizon. I think to Mike's point, you know, the town doesn't retire at age 65. So I think when the investor has an infinite or evergreen time horizon, you can generally be much more aggressive. As long as you recognize that opening or exposing the portfolio to more long-term equity type investments, they tend to be more volatile in the short term. If we needed to draw on this account in the next, say, 3 to 5 years, I probably wouldn't want to be so aggressive. But if our time horizon is genuinely very long-term or completely infinite, in my view, there's not a need to be so tethered to fixed income. And we'll see volatility over the short run, but over the long run, historically, the equities market have returned about 8%. So I feel reasonably confident that history will continue to repeat itself, and we may be in for a bumpy ride over the next few years, but over the long run, I would hope that we would see some better gains in the portfolio by allowing for a wider range of equities. So it'd be my recommendation to move that range all the way up to 60 or 65%, which would allow for a portfolio like the one that Dominic recommended. Again, recognizing that we don't have to go all the way that far, but allowing it in the policy would permit that flexibility. Any other comments from the committee?
Can I ask a question?
Sure, please.
So what Dominic proposed basically was a 40-60 split between cash and fixed income and equity. So would 60% equity be the bottom of your range? And that would include the private equity portion if you decide to go that way. So would that be the bottom of your range, or would that be the midpoint of your range?
Yeah, I would not make it a bottom, because I think you always want the flexibility to have less. So I have actually no objection at all to the range bottoming out as even low as the 15% that's shown here. I think it's more a question of what should the top of the range be. I think a 60-40 portfolio is generally considered to be fairly conservative. An 80-20 portfolio is considered to be pretty aggressive. So, you know, I split the difference, and I would say 65, maybe 70% would be the upper limit. I would probably recommend that we keep it on a day-to-day basis in the 60, you know, 60-40 split. But I think it's good to have a little bit of flexibility in case markets change and you want that extra added flexibility. Or for instance, he allocates it today at 60-40 and the portfolio changes and shifts, the equities just perform better, as I would expect they will. You want to leave yourself a little bit of a cushion so he's not forced to rebalance the portfolio and sell just because equities have crept up to, say, 65%. So I think you want to leave a little bit of a cushion, but I don't think I would recommend that we go all the way up to 80%. Any other comments or questions from anyone on the committee or our commissioners? Well, I think we're in the same position we were before. We really need to just make a decision. Do we want to tweak these ranges? I'm in favor of changing them. I think Mike is in favor of changing them. Dennis or Bernie? And actually,
I agree. I concur.
okay.
I agree that we should torque them. Change them.
The
Do you,
only question I had, should you allow a percentage below 60 in your range? I mean, you really are using 60 as the bottom. So you're trying to go 60 to 65, but
yeah, I mean, I think that's a fair question. I mean, as I noted before, I prefer that we do allow to go lower, just for sake of flexibility and convenience. I mean, I can imagine a different market where, from just a portfolio management standpoint, you may want to reduce your equities below 60%. I mean, going all the way down to 15% maybe is unrealistic, but I don't have any principled objection to allowing for it. But I invite others to share their views of what you think an appropriate range is. I mean, I'm comfortable, say, going up to 65 or 70% as the maximum. I'll say 70 just to keep the conversation moving. On the low end of the range, I'm comfortable leaving it at 15. I'm also comfortable raising it. I probably would not raise it above, say, 30%. I think we want the flexibility to always drop the concentration of equities. And
I have a little chocolate.
any views from the committee?
Well, yeah, I would agree, because I remember in 1980 when I had a 11.5% CD. So
Yep.
markets will change.
Yeah, and we could be headed that direction. I mean, who knows?
Oh, no.
Yeah, I hope not. I'm glad my mortgage is locked in. Any other thoughts on an appropriate range?
Yeah, if somebody could just run through, we keep moving numbers around and I'm not sure what the proposed range for equities is and what it is for fixed income. And also, does it have to always add to 100? That's a question I'm asking.
I mean, at the end of the day, what you actually invest must total 100. But the two ranges for equities versus fixed income don't necessarily have to match. You just have to make sure that the actual investments never exceed 100%.
Okay, fine. Thank you. And
but-
what about the ranges?
I mean, I don't mean to suggest this is a bid, but to keep this conversation moving, I would suggest that we have a range for equities of 30 to 70%. And we would correspondingly change the fixed income from 70 to 30 or 30 to. Yeah. I think Dennis gave a thumbs up for the 30.
That was not a finger, that was a thumbs up. Look like a finger.
I'll go for that.
All right, so we've got a couple votes for that. All right, well, what I would propose, and I'll ask for a motion on, is that we, with respect to the short-term component of these allocations, that we change to allow for equities of 0 to 10%. We would also import the definition of equities into the short-term component, but we will add a restriction on the types of equity investments such that they should be focused on value and dividend producing type equity securities with lower volatility. For the long-term component, I would propose that we change the ranges to allow for 30 to 70% for both equities and fixed income. I think that gives maximum flexibility to the portfolio manager. And I would also propose that for this portion of the definition of equities, so only with respect to the long-term component, that we allow up to 10% of the equities to be invested in illiquid holdings, private placements, or closed-end investments, including real estate investments, just so we're explicit. And I think that would allow for everything that is in Dominic's proposal. Whether we actually direct him to follow that is open up for further future discussion. But that's what I would propose. And I would ask for a motion to approve that. I would present these as changes at the next meeting to be voted on and final to be forwarded to the town, to the council. Do I have a motion for that?
I have a motion to approve.
And I'll second it.
And all in favor, say aye.
Aye.
Aye. Are there any opposed? Hearing none opposed, that passes unanimously. So we will present that recommendation at the for a final vote in form. I think we've agreed on the terms, but I will reduce it to writing for a revised investment policy so that we can present that to the town council. I think that is the last item on our agenda, other than future meetings. But before we get to that last point, I just invite the committee. Are there any other issues that you wish to discuss this evening? Any other comments from our commissioners or the town manager?
Nothing from me.
Okay.
Nothing, Brian. Thank you.
All good
Then I
here.
think the last item is just future meetings. The only proposed change I would have here to accommodate one of our commissioners is that we had these meetings set for 5 p.m. I think 6 p.m. is a better time for the group, if that's okay.
I appreciate that if you might be doing that for me, but if I have advance notice, I can make my schedule match it. It was just because it was a quick
Oh,
change that I had to
okay.
make an adjustment. So
Okay.
5 o'clock is fine as long as we stick to what we said, which would have been the April 14th, July 14th, October 13th. Is that right?
Yep, that is correct. So it's the second Thursday of each month, 5 p.m.
Not each month,
Yep. Quarterly, I'm sorry.
quarterly. Yes. Yes. So 5 o'clock quarterly. Thank you.
Yep, with the dates that are noted there. So April 14th, July 14th, October 13th. Okay, everybody in agreement on those dates? Have a motion to confirm those dates?
Motion to confirm the dates.
Second? All in
Second.
favor? Aye.
Aye.
Any opposed? All right, unanimous. Our meeting schedule will remain the same. I think that is all our business for today, and we will adjourn the meeting. It's 7:45. Thank you very much, everyone. Appreciate your time tonight.
Thank you.
Thank you.
Thank you.
Good night, everyone.
Good night.
Great job.